There are 19.6 million Bitcoin out there right now, and the highest it will ever go is 21 million. Okay, there's real scarcity value. And what is going to happen? The price increase for every institutional dollar pushing in now is going to be much higher than it was last year, 2 years ago. We think in the next 5 to 10 years, you will not recognize the world as we know it today.
The total amount of Bitcoin that will ever be available is 21 million. There are 1.4 million still to be mined, and of the 19.6 million that have been mined, 2.4 million have since been lost. Cathie Wood, the founder of the $60 billion investment management firm ARK Invest, extensively delves into Bitcoin's emergence as a new asset class within the global monetary system. She believes that in the next 5 to 10 years, you will not recognize the world as we know it today. Since its inception in 2009, Bitcoin, the world's oldest cryptocurrency, has attracted the attention of fans, investors, scammers, and more recently, regulators. Bitcoin's most recent rally has brought it within arm's reach of its all-time high, but some experts say this is just the beginning. The most popular cryptocurrency surged above $63,000 before slightly retreating on Friday afternoon. The coin is now up more than 30% year-to-date and nearly 170% compared to last year. In January, Cathie Wood said on CNBC that Bitcoin, the world's largest cryptocurrency by market value, could reach $1,500,000 in price by 2030 in a bullish scenario, raising her estimate by 50% from a previous prediction of $1 million. Additionally, experts expressed optimism that institutional interest in Bitcoin through ETFs is accelerating mainstream technology adoption. Spot Bitcoin ETFs see record inflows. At the moment, the funds have already accumulated over 300,000 Bitcoin. For 2 days, February 26 and 27, the daily trading volume for spot Bitcoin ETFs exceeded $2 billion. Cathie argues that Bitcoin transcends mere technology. It represents a new asset class. Furthermore, she asserts that it extends beyond this designation to serve as a cornerstone of a global monetary system. Ready to uncover more insights? Remember to subscribe and turn on notifications always to get our latest content.
We have all kinds of metrics, but when I was at Abundance, the forecast was, our bull case was $1.5 million in 5 years. So that would have been 2027. We still have time. And we still think that's going to be right. If you just look at the institutional push into Bitcoin, this new asset class, they have to consider it as fiduciaries. When you use those code words, new asset class, what it means, the correlation of these returns are very low compared to those of other assets. Typically, when you go through a price move, a Bitcoin price move to the upside, you usually see long-term holders, which is a metric we monitor. It's an on-chain analytics metric. And it means people who have not moved, or wallets that have not moved their Bitcoin in 155 days or more. Yes. Well, normally when you go through a price move to the upside, a very nice one like we've seen in the last year, that tends to start moving down. And it did that, true to form, but it has reversed in recent days because what we learned is GBTC sold some of its Bitcoin. So those wallets hadn't been changed in a long time, right? Now that is done, at least for the time being. Now that is done, and it's going back up again as the price goes up. That's highly unusual. And I think it is because the long-term holder is saying, why would I sell now when I know all these institutions, which own nothing in this realm, in this new asset class, they have to consider it because it is a new asset class. This is not just a technology. It's a new asset class, right? And beyond that, it's a global monetary system. You know, it is the first global private, meaning no government oversight, digital and decentralized, rules-based. That's the most important word here. Rules-based monetary system in history. It's a big idea.
With tech companies and stocks buzzing amid a tight race in AI development, one economist is warning that the current AI hype has surpassed the 1990s dot-com era bubble. The previous week, NVIDIA beat out Amazon and Google's parent Alphabet to be the third most valuable company in the U.S. by market cap. The company saw its stock dip before fourth quarter earnings as investors worried the rally had gone too far. Still, NVIDIA beat Wall Street expectations when its revenues increased 270% from the previous year to $22 billion. Cathie noted that exponential growth hasn't been discussed in finance since the dot-com and telecom bubble, leading to skepticism about sustaining growth rates of 15 to 25% annually. However, she believes that what lies ahead is exponential and super exponential growth due to the convergence of different technologies. Now, let's redirect our attention to a video.
In the financial world, exponential, that concept, the last time investors heard it was during the tech and telecom bubble. And for them, that ended badly. Now they just don't believe it. They don't believe it's possible to sustain growth rates at 15, 20, 25% plus per year. But what we think is going to happen is not exponential growth, but super exponential growth as we get the convergence between among technologies out there. I think there were a lot of people in 17, 18, 19, 20 who were looking at what we were doing, and they were starting to copy us. And I was thrilled with that. And then we hit 21 and 22, which was a bloody disaster. Interest rates.
Fear causes retrenchment to the norm.
Well, and a 24-fold increase in interest rates. Never happened in history. Crucified all long-duration assets, even bonds, long-term bonds, which were where safety was supposed to be. They had their worst year in 250 years, since the 1700s. So, that we couldn't win. Now I think we're on the other side of that. Now people are trying to figure out, why aren't long-term interest rates continuing to go up if the Fed says inflation is still an issue? And they're not going up because the real issue is deflation. I think in the traditional financial world, which is where there are the trillions and trillions of dollars, the reason is because of the move to passive investing. Now, this used not to be a thing. When I started in the business in the late 70s, early 80s, asset managers were all active, which simply means they were trying to figure out how the future was going to work. And they would do so using macro analysis, so economics and so forth, as well as micro analysis, company by company. And then in 2000, with the tech and telecom bust, we had this shift towards benchmark style investing, accelerated shift, benchmarks being S&P 500, NASDAQ, MSCI World. And then even more so after 08, 09, the financial meltdown, we had an accelerated move towards passive investing. And why was this? It was a self-fulfilling prophecy as more and more active managers became benchmark sensitive. They were bidding up those stocks in the benchmarks, of course. Now, the other thing that happened to active managers, which was really terrible, is while they were doing that, they were charging fees. And yet they were starting to look like these benchmarks that don't charge fees. And so they were already behind the benchmarks at the start of every year just because of their fees. And so you had the self-fulfilling prophecy. And now what we have is, I think it's almost 75%, definitely north of 50% of all assets under management are in the passive style. which means they simply mimic a benchmark. I believe this is the most massive misallocation of capital in history.
Bitcoin's performance in 2024 depends on various potential bullish and bearish catalysts. Numerous factors, such as institutional adoption, halving, regulatory changes, and macroeconomic trends, will influence the price of Bitcoin in 2024. Bitcoin, the leading cryptocurrency by market value, has gained over 40% in 4 weeks and is trading just 10% short of its record high, near $69,000. We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.